Good evening and welcome to the Economic Club of Miami's opening event for this year, a fireside chat and an address by Federal Reserve Board Governor Chris Waller and Jon Hartley, our co-founder and my colleague. First, let me start by a large thank you to our host. You've been incredibly gracious and we are incredibly grateful for all the things you've done on our behalf to make this event happen. I'd like to thank all of our sponsors, all of our supporters, and I would also like to thank our growing membership here in the city of Miami. When people ask, what's the secret to the Miami miracle? It's not just the lowest crime rate in the history of the city by supporting our police and funding them. It's not simply the lowest millage rate in the history of the city of Miami, which has unleashed an entire era of growth. And it's not simply the culture of innovation that we've built and that this organization represents, a culture that celebrates success, that doesn't attack success, and a culture that believes that you should keep what you earn, invest what you save, and own what you build. But the real secret of the Miami miracle is you, the members, the people who believe in innovation, investment, and the promise of a free market society. In this age and era of tremendous innovation, disruption, and transformation, it is incredibly important to have the type of discussions that we are having tonight. My colleague, Jon Hartley, will be interviewing Federal Reserve Board Governor Chris Waller. Jon is an economist with the Hoover Institution, and he is a policy fellow. His background is in macroeconomics, central bank behavior, and a wide publication history that's included op-eds in the Wall Street Journal and many other distinguished publications. Our main speaker tonight will be the Honorable Chris Waller. He is a son of Nebraska who completed his PhD at Washington State University, who has had a string of distinguished appointments at the University of Indiana, the University of Kentucky, and the University of Notre Dame. He has been recognized globally as an expert on monetary policy, macroeconomics, and the challenge of political economy, especially in this very dynamic era. We are grateful for your time. We are grateful for our audience. And we'd also like to thank our friends at Fox Business, Bloomberg, C-SPAN, and the Federal Reserve Bank for all of their graciousness and for their friendship in making this event available to all of you watching at home. Without further ado, let me introduce both my colleague and co-founder, Jon Hartley, and Federal Reserve Bank Governor Chris Waller. Thank you.
Got so many mics, I don't know what to do with them all. Well, thank you, and thank you to the Economic Club of Miami for the opportunity to speak to you today. Since I last spoke on the economy and monetary policy on July 17th, economic data have reinforced my view of the outlook and my judgment that the time has come to ease monetary policy and move it to a more neutral stance. In July, I argued that looking through tariff effects with underlying inflation near target and the upside risk to inflation limited, the Federal Open Market Committee, or FOMC, should not wait until the labor market deteriorates before we cut the policy rate. Based on all the data in hand, I believe this argument is even stronger today and that the downside risks to the labor market have increased. In July, Looks like we need a mic change. All right. Woo! In July, I warned that job creation was weaker than it seemed in the payroll numbers, and the data due in early September would indicate that payroll growth will be significantly lowered when annual revisions are made next spring. But even before then, job creation came in soft in the employment report for July, and May and June numbers were revised down sharply for a 3-month average pace for total non-farm payroll growth of only 35,000. After accounting for the revisions that will be coming at some point, and what we will learn in a couple of weeks, the data are likely to indicate that employment actually shrank, was negative over those 3 months. I will have more to say about labor market data revisions and how they should be treated in evaluating the monthly jobs reports, one of the most valuable tools we have for judging economic conditions. I favored reducing the federal funds rate by 25 basis points at the FOMC's July meeting, and subsequent data on the labor market and inflation indicate that that was the right call. That also seems to be the message from financial markets, which now expect a 25 basis point cut at the FOMC's September meeting, and put significant odds on an additional 1 or 2 cuts at the final 2 meetings of 2025. As I will discuss, factoring these out, estimates of the temporary effects of import tariffs, underlying inflation remains close to 2%. I believe data on economic activity, the labor market, and inflation support moving our policy toward a neutral setting. Based on the median of FOMC participants' estimates of the longer-run value of the federal funds rate, neutral is 125 to 150 basis points lower than the current setting. While I believe we should have cut in July, I'm still hopeful that easing monetary policy at our next meeting can keep the labor market from deteriorating while returning inflation to the FOMC's goal of 2%. So let's get on with it. Turning to the economy, economic activity has slowed significantly in 2025 from 2024. Growth for the first half of the year was 1.4%. Looking ahead, the limited evidence we have is consistent with continued sluggish growth. We don't have much data for the second half of the year, but smoothing through monthly volatility, retail sales for July suggest that consumers are continuing to spend, albeit at a slower pace than last year. Meanwhile, manufacturing output in the report on industrial production was flat in July. And according to purchasing managers, new orders for manufacturing are consistent with a modest decline in the last few months, or in the next few months. For the large majority of businesses outside of manufacturing, new orders are consistent with roughly flat production in the coming months. Many forecasters have said they expect household and business spending and investment decisions will be weighed down by tariffs, those enacted, and any uncertainty about the tariff levels in the future. Tariffs affect the costs and profits of businesses, and to the degree that they raise prices, they also affect the real disposable income of consumers. Some businesses will be directly affected by tariffs, but many more will be affected by how tariffs crimp household spending. Tariff effects on households and businesses also will weigh on employment. All of this is consistent with what my business contacts are telling me, which is that they are postponing investment and hiring because of the uncertainty about how tariffs will affect their input costs and demand for their products. That said, I'm also starting to hear some rumblings that businesses cannot sit on the sidelines forever. So we could see at least investment projects that were postponed begin to pick up in the second half of this year, which would be positive for the economy. But how employment decisions evolve is more up in the air. I'll be monitoring these business decisions because they are key to how activity will unfold in the second half of the year. Returning to the labor market, risks are continuing to build. In my July 17th speech, I said that private sector job creation was nearing stall speed, and the data received since then have put an exclamation point on that statement. I always say that 1 month is not a trend, but now we have 3 straight months. That job report was not 1 report, it was 3 reports. We have 3 months of weak job creation data from the current employment statistics. Again, after revisions included in the July report, private sector job creation averaged only 52,000 jobs in May, June, and July, about half the rate in the first quarter of 2025. The headline numbers, including public sector workers, are, as I noted earlier, even worse. But I tend to focus on the private sector as a better indication of the underlying momentum in the labor market. So that's the picture after the unusually large revisions to May and June payrolls and the soft reading for July that was included in the latest jobs report. In addition to these revisions, on September 9th, we will get a preliminary estimate of what to expect in the annual benchmark revisions in 2025 early next year. And these revisions are based on the unemployment insurance data that all firms have to submit and covers something like 98% of all firms. And that will be the ultimate number that we think about for job creation. Now, we estimate that the monthly job creation will be reduced by an average of about 60,000 a month when this data comes in. That would mean that private sector employment actually shrank on average in the past 3 months, and that job creation earlier in the year was weaker than currently reported. Now, I have heard the argument that declining labor supply due to lower immigration means that low jobs numbers aren't as bad as they look, and that the break-even number for keeping the unemployment rate steady is falling. To those people, I would say, yeah, the estimates have been falling. But I haven't heard anyone say the break-even level is negative. Supply-side changes can't account for the ugly job numbers we've seen in the past 3 months. Other data support the idea that labor demand may be on the edge of a sharp decline. For example, wage growth for people switching to jobs is lower than for people who stay in their jobs. The opposite of what we usually see in a strong labor market. A few years ago, the rate of people quitting their jobs surged, and job switchers were getting substantially larger raises than those who stayed in their jobs. Today, the quits rate is back down to the mid-2010s level, and these individuals must be switching jobs for reasons other than gains in compensation. Another sign of a weakening in the labor market is that the unemployment rates for some cyclically sensitive groups of workers, such as teenagers, are up sharply this year, to levels again similar to those in the soft job market of the mid-2010s. Supplementing this hard evidence of falling labor demand is the consistent story from all of my business contacts around the country. They are not hiring. The mix of reasons is not only uncertainty over tariff policy and slowing demand for goods and services, but also increasing uncertainty over how to use artificial intelligence, which is especially freezing hiring for some entry-level jobs. This softening in labor demand is occurring at the same time, as I noted earlier, that there is a decline in labor supply. I often hear the argument, I thought I'd repeating the same steps. I often hear the argument that the unemployment rate is the key labor market indicator because it reflects what is happening in both demand and supply. And given that the current unemployment rate is 4.2%, close to most estimates of maximum employment, and it has barely changed over the last year, this suggests that the labor market is solid. Now, while I would normally agree with this statement, I don't think it's accurate now. I believe that any decline in labor supply is only masking weakening demand in the labor market. Whether or not supply is down, weakening demand is not good, and it is specifically what monetary policy is intended to address. Before I move on from the labor market, let me address a question of some public debate recently, which is the quality of the payroll data. It should be obvious from these remarks and others I have delivered I consider the monthly jobs report, including its estimate of payroll employment, an absolutely indispensable tool in valuing the economy and setting monetary policy. And that view is close to unanimous among all economic forecasters and policymakers. Considering how important this data is in getting an accurate and reliable read on the state of the labor market, it is entirely appropriate to examine the quality of the jobs numbers and the process by which they are collected. There is always room for improvement in data collection and analysis. In fact, the Bureau of Labor Statistics, or BLS, and other agencies that collect economic data have benefited from expert committees of outside advisors who have provided advice on ways to improve data quality. There has been substantial commentary since the last jobs report regarding the declining response rate of establishments and individuals in the employment survey and the outside revisions of the data. This commentary has raised questions about the quality of the employment survey data. So I want to address this issue and clarify some facts about the survey response and the revisions. When the BLS sends out establishment survey for a given month, it gives firms 3 months to fill out that survey. They can return it in the first month, the second month, or the third month. Some firms do not respond at all. Firms that submit their responses in the first month are the basis for the initial, or what's called a preliminary, payroll estimate. Those firms that respond in the second month get added to the first month responders to get an updated number, which yields the first revision that is published a month later. And then the firms that respond in the final month provide the BLS with the final numbers for the original month that they asked for. This is the second revision, and it is the official payroll estimate for that month. Now, a decade ago, the response rate for the first month was 75%, meaning 3/4 of the firms that were surveyed responded immediately. But the initial response rate has now fallen to 60%. Now, does that imply that the overall response rate for the entire 3-month period has fallen? The answer is no. Response rates by the final estimate have not fallen. About 95% of firms responded a decade ago over the whole 3 months, and that is exactly how many are responding now. What has happened is that U.S. firms are slower returning the survey. Don't ask me why, but that's what's happening. So 10 years ago, if the survey had been sent to 100 firms, 75 would respond in the first month, and 20 firms would respond in the next 2 months. But now only 60 firms respond in the first month, and 35 firms respond in the second and third months. But in both cases, 95 out of 100 responded. So what are the implications of this delayed response by U.S. firms in returning the survey? First, if more data come in later in the survey period, then the initial estimate is less likely to be accurate and represent the final estimate, which means you are likely to get more significant revisions in the second and third months. This is just arithmetic. The revisions do not mean the quality of the data has declined. It simply reflects the fact that more data is coming in later in the period. The second point is that revisions have been, on average, negative for the past couple of years. And while the recent revisions were large, revisions over a longer time period have not been getting bigger on average, based on analysis recently issued by economists at J.P. Morgan. What they did find is that large revisions are often associated with major turning points in the labor market. So one possibility is that the recent large revisions in the payroll data for May and June indicate that the labor market is at an inflection point and may worsen in the coming months. And that's what matters to me. Overall, the delay in responses does mean that we can expect initial reports to be noisier and more prone to revision. 1 month of data has never constituted a trend, but is going to be especially important to take near-month payroll data with a bit more of a grain of salt than we used to get a firm picture of the labor market. Now, I hope my analysis of the labor market shows you that I do exactly that. So let me turn to the outlook for inflation. Earlier this month, we received consumer and producer price information for July that allows for an estimate of inflation based on personal consumption expenditures, or PCE inflation, which is the FOMC's preferred measure. Now, based on those reports, PCE inflation increased approximately 2.6% over the 12 months ended in July, and PCE inflation, excluding food and energy, increased 2.9%. We will get the official data for PCE tomorrow, so stay tuned. Now, inflation has increased since the first quarter, but these numbers that I just gave you include the effects of import tariff increases, which, with inflation expectations anchored, I continue to expect will only temporarily raise inflation. Federal Reserve staff has extracted tariff effects of inflation, and their latest estimates imply that without the tariffs, underlying inflation would be running close to the FOMC's 2% target. Now, there's still considerable uncertainty about how much more and how quickly tariffs will pass through to consumer prices. I have seen estimates that vary wildly in the share of tariffs borne by exporters, importers, and consumers. And that tells me that one must be very careful not to presume that some will bear a lot more than others. I continue to assume that the three groups affected by the tariffs will tend to share the costs roughly equally, meaning 1/3, 1/3, 1/3. Most forecasts are for 12-month inflation to continue to increase for a couple more months, with monthly tariff effects dissipating by early 2026. I believe that monetary policy should look through the tariff effects on inflation. I've been saying this for a year. With underlying inflation close to 2%, market-based measures of longer-term inflation expectations firmly anchored, and the chances of an undesirable weakening in the labor market have increased, proper risk management means the FOMC should be cutting the policy rate right now. I felt this way in July, and all the evidence since then has led me to feel more strongly about it today. Based on what I know today, I would support a 25 basis point cut at the committee's meeting on September 16th and 17th. While there are signs of a weakening labor market, I worry that conditions could deteriorate further and quite rapidly. And I think it is important that the FOMC not wait until such a deterioration is underway and risk falling behind the curve in setting appropriate monetary policy. My eagerness to move now is supported by my view that monetary policy is modestly restrictive. In June, the median of FOMC participants estimated that the longer-run value of the federal funds rate, akin to what it would be without restricting or stimulating the economy, is 3%. With the target for the federal funds rate in the range of 4.25% to 4.5% now, that means we are 1.25 to 1.5 percentage points above neutral. So we have a ways to go. While I judge that the FOMC should have begun this process in July based on the data in hand, I don't believe that a cut of larger than 25 basis points is needed in September. Now, that view, of course, could change if the employment report for August, due out a week from tomorrow, points to a substantially weakening economy and inflation remains well contained. I think there is a growing consensus that monetary policy needs to be more accommodative, and even some recognition that it would have been wise to begin the process in July. I don't believe the policy has fallen substantially behind the curve, but one way to signal that I don't intend to allow that to happen is to talk about where we go after September. Like other participants, I will be updating my economic projections just before the next FOMC meeting, including my assessment of the appropriate level of the federal funds rate at the end of this year and next. The totality of the data and the outlook will determine how quickly I believe we need to move policy to a neutral setting. But as I stand here today, I anticipate additional cuts over the next 3 to 6 months, and the raised pace of rate cuts will be driven by the incoming data. Thank you very much for your time.
Fine. can use that one, like.
Get to relax.
All right. Well, thank you. Well, thank you, Jeremy, for that kind introduction earlier, and thank you, Chris, for that excellent speech. And thank you, everyone, for coming. It's a real honor to have Governor Waller here, and it's I think a very fascinating time for the Fed. So this is a live recording of an episode of the Capitalism and Freedom in the 21st Century podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where I, Jon Hartley, am your host. I'm also a policy fellow at the Hoover Institution. It's so great to have Federal Reserve Board Governor Chris Waller here as my guest for this live episode at the Economic Club of Miami, which is also being live streamed on Bloomberg, Fox Business, and C-SPAN. Chris, thanks so much for coming to Miami and for coming on the show.
Thanks. This is my first podcast. I'm looking forward to it.
All right. Well, first question, and then let's get started and maybe address, I guess, the what some may say is the elephant in the room. Some of your colleagues at the Federal Reserve Board are in the news. For those who haven't been following the news, any comments on the status of this situation? I think there might have been a lawsuit dropped today or something like that.
Yeah, when it comes to this, I really don't have any comment. Things now are in the hands of lawyers and the courts, not a poor, simple policymaker like me.
Okay. All right. Well, moving on to our first economic question, really about the federal funds rate and where it's going. You gave us a great economic outlook in your speech. CPI inflation now is both headline and core is about 2.7% year over year. It's been below 3% for quite a while. Unemployment's been around 4.2% for a while. And there's still another non-farm payroll report that's still has to come up between now and the next FOMC meeting. So that could change a little bit. But the Fed funds rate is currently at 4.25%. You said earlier that you'd like to see maybe a 25 basis point cut at the next meeting. Would you like to see more cuts at further meetings down the road? I'm curious, what's your position on sort of the trajectory of the Fed funds rate?
Yeah, that's what I said at the end of the speech was I fully expect more rates cuts as the labor market continues to soften. Growth is probably still going to be slow in the second half of the year. And the tariff effects, any tariff pass-through effects will probably peak by the end of this year, beginning in 26. So because monetary policy tends to work with these kind of long lags, you don't want to wait and then you're behind the curve. So my view is we should start getting ready, look through whatever price effects are happening right now. I don't believe they're going to be persistent. I know I'm a bit of an outlier in the FOMC because of that. But this is exactly what economic theory would tell you. Look through the tariffs. Inflation will flatten out once the tariff effects are passed through. And then we can continue moving on, cutting to protect the real side of the economy. But the pace and the speed, I like to give this example. I went to college in northern Minnesota. When I would drive home for Christmas, I knew exactly where I was going. But how fast I got to Minneapolis depended on the weather. And the weather's like your current data. It determines whether you can go fast, whether you got to go slow, how much you can. So that's the kind of way I think about the rate cuts. We know roughly where we're going, towards neutral. But how fast we get there is going to depend on the data that comes in.
So you'd prefer a pace of sort of potentially successive 25 basis point cuts, not a bigger 50 basis point cut or more at the beginning.
Yeah, and it's not a set sequence. It's not 25. That's what I mean by the data. The data will kind of determine how fast we go. It could be a sequence of cuts. It may be a couple. Then you may want to pause if the data is coming in an odd way. So that's what I mean. How fast, you know where you're going. That's the key thing. We know we want to head towards neutral. It's just a question of how fast we get there.
So I'm a nerdy economist like yourself. I want to ask you about R-star.
Does anybody know what R-star is?
No.
See?
So for those who don't know, R-star, it's really the level of the interest rate where inflation's neither accelerating or decelerating. So it kind of tells you, where are we at in terms of whether monetary policy is tight or accommodative. And so the Fed funds rate's currently at 4.25%. So if you thought that the R star was much lower, then you'd say, it's a very tight stance of monetary policy right now. If you thought R star was at about 4.25%, you would think that we're at neutral. So I'm curious, one, there's a lot of different ways in which people assess R star. There's model-driven estimates. There's the Lubbock-Williams estimate that's about 2.75. There's the Lubick-Matthews nominal R star that's around 3.75. These are nominal numbers. I'm personally a fan of the survey-based R star estimates. The New York Fed has this survey. It's called the Survey for Market Expectations. They ask Wall Street types or hedge fund or primary dealers, market participants, what the Fed likes to call them, and ask them what their estimates of R star is. And you can take the median of that, and that's about 3.25 right now. And that median pretty closely follows the FOMC median R star estimates that are put in the Summary of Economic Projections. We don't get to see or know who the dots are in the famous dot plots. Chris is one of them. But I'm just curious, sort of big picture. One, where do you think R star is? How do you think about R star? You're a monetary economist. How do you think about formulating that in your own mind and sort of creating your own dot? I mean, do you follow survey-based estimates? Do you follow model-based estimates? Do you follow market-based estimates, say, long-run interest rates and so forth? How do you think about it as a monetary economist?
Well, so just the way I think about R star is if the FOMC or the Fed, if we were hitting our inflation target at 2% and we were at maximum employment where that's your goals for the dual mandate, and you're hitting them and you're sticking there, and inflation expectations are anchored, what should the interest rate be? That's what we call R star. It's like, what would it be if you were right on target and everybody's expectations were anchored? The interest rate is composed of two parts: some expected inflation, which should be hopefully 2% if you're on target, and some real rate of return. And the real rate of return used to be thought of as 2%. So if you had a 2% target for inflation and a 2% real return, the nominal rate at neutral would be 4%. That was kind of standard wisdom for a long time in central banking. What we noticed about 10 years ago was this real rate, even though inflation was anchored pretty much around 2%, the real return on safe liquid government debt was falling from about 4 to 2 to close to 0 about 10 years ago. So there was something going on that people were willing to pay more and more, a higher and higher price for safe liquid U.S. government debt, which meant that the yield that they got was going down. So this is where this whole debate about R star, it was falling. It's been very low. And now the debate is it going back up? Is it going to stay low? I know this is totally geeky. If I were sitting in the audience, I'd be shooting myself. But this is a serious problem for a policymaker and geek nerds like John. So that's kind of where we're at. When I was saying 3% was a median estimate, that's what I mean. Right now, we think if you had a 2% inflation target, the median FOMC member would think that the real interest, once you net out inflation effects, would be about 1%, which is significantly lower than 2%. And certainly lower than about 4% early in the mid-'80s. The question is it going to continue? Is it going to start rising? And it was close to 0. It's up to about 1. Is it going to keep going, or is it going to stay there? And that's where a lot of energy, research, discussion has tried to figure out where do we think this is. And as John said, these numbers are kind of all over the map. If you even look at the FOMC Survey of Economic Projections, they run from about 2.5% to close to 4%. So even on our committee, that's how big of the range is and how much uncertainty there is. So that's basically the way I kind of look at it is it's going to be a point estimate that moves around over time. And I gave a speech back in May of 24 at the Central Bank of Iceland where I gave a whole speech on what does it mean about R star? Why has it been falling? What did I think caused it? And what do I think could cause it to go back up? So if you're really bored some night, go find that speech and give it a read.
That's very enlightening. I want to, as a nerd, very enlightening for me selfishly. Well, I do want to talk a little bit about inflation, but inflation during the COVID pandemic. And I think a lot of people here probably remember this, and I'm sure some people may still be upset about it. We did get cumulative inflation or a price level increase of 20%. We that's permanent. We haven't reversed any of that. I'm curious, what did Team Transitory, those at the Fed who thought that sort of inflation would come back down without Fed funds rate hikes at the time, what did they get wrong? And I'm curious, should the Fed have started raising interest rates earlier than March of 2022? I'm curious what your theory of the early 2020s inflation is. Was it supply-induced inflation, demand-induced inflation by, say, stimulus and so forth, supply-induced by, supply chains and so forth, or was it a supply and demand-induced inflation in your mind?
Yeah, it clearly was both. I mean, the whole COVID panic was a problem because it kind of hit the whole world. And then when everybody's working at home or sitting at home, you can't really produce stuff. So whatever's being available out there, the prices start being bid up because everybody's sitting at home with nothing to buy the goods. So some of it was just the supply chains were restricted. We were all still buying. There was a lot of stimulus from the federal government and the Fed as well to try to support, because we really thought this would turn out to be something like the great financial crisis where we have to step in and do a lot. So you had both the supply side from supply chain, demand from supportive policy, and then the economy just recovered faster than I think we thought. So I was on, throw all the knives you want, but I was on Team Transitory in 2021 because I gave a speech in May of 21. I said, look, what are all the reasons people think inflation is going to go up? And I walked through every single one of them and said, these are just price level effects. They don't just cause prices to continue to go up and up and up and up and up. My economic reasoning just said it can't happen. So that was, I think, a general belief that we had. What happened is those price level effects turned out to be much bigger and much more persistent than I know certainly I can't speak about any of my colleagues, but for me, it was a surprise at how big and persistent these changes were. And I kind of gave a speech. I gave a speech in Korea back at the end of first week of June, where I kind of laid out what caused this persistence. What was it that caused all these things? So I don't want to go through a big hullabaloo about it, but those things, which was like the COVID, it wasn't just one wave of COVID. It was wave after wave after wave, and they weren't synchronized around the world. So we would start reopening and somebody else would shut down. And every time somebody shut down, they broke the supply chains. And we still had a lot of stimulus money pouring in. Fiscal policy was very accommodative. Monetary policy was accommodative for too long. And that also just led to more persistence in inflation. Now, why is this important? Because from that experience, we should have all learned our lesson that you don't say the word transitory. And what am I doing? I am saying whatever tariff inflation you get will be transitory. That was a pretty bold thing to say about 8 months ago because everybody immediately said you're an idiot. But I think we're now starting to see that tariffs are a very different thing. It's not clear how much is going to get passed through. It's one thing causing it. It's not like multiple broken chains, fiscal policy monitoring. So it's, to me, very clear there's really one thing we got to worry about. Those prices, if there's any pass-through, there'll be some. Once they pass through, it's over. And it won't continue to cause prices to go like that. So based on that, long-standing central bank wisdom is you just look through it. Just like if you increase the sales tax in every state, that would raise the price of what everybody has to pay. But no one would say, oh, that's going to just cause inflation to go taking off. And I doubt very much that workers would go to their bosses and say, hey, the city just raised my sales tax. I need a raise. I don't think your boss will pay any attention to you. So, but it's weird with tariffs. That's immediately what people start saying. Oh, tariffs, prices will go up and it'll be more expensive. I got to ask for a raise. Well, you don't do it on the sales tax. You don't do it if your income tax goes up or any other taxes go up. What is it special about tariffs that makes you want to act differently? So that's kind of where I'm at. I'm back on Team Transitory. We'll see how it all works out. Some of my colleagues have some bets against me, but I'm sticking to it. That's my line.
Very good. Well, I want to talk a little bit about Jackson Hole, where you were last weekend in Wyoming, and there was a lot of discussion about Chair Powell's speech, in particular on the Fed framework review. He, I think, suggested last week that the Fed, from a framework review standpoint, was potentially returning to the sort of 2012 Bernanke symmetric 2% inflation target, and kind of abandoning the so-called flexible average inflation target, or FATE regime, that was adopted in the last framework review that was in 2020 and sort of a brainchild of Rich Clarida. Any thoughts on the 2025 framework review? Where do you think it should go? Where do you think the Fed should go from a framework review perspective in your mind?
So for those of you, again, who are central bank geeks, a framework, we have a goal. Our goal is 2% inflation, price stability, which is how we define it, and maximum employment. Those are great goals. How are you going to get there? What's your strategy? How are you going to act when the data isn't getting you there? So that's when John says our framework, that's how we interpret the framework. It's our strategy for how we're going to respond to the data to get us to these goals. That's kind of the simplest way to explain what the framework is. Now, in our last framework, we had spent 10 years with inflation running well below our 2% target. And you'd say, well, what's wrong with that? Okay, maybe there's nothing wrong with it. But inflation expectations started drifting down away from 2%. And so what that implied is our promise of 2% is losing credibility. Whether you like it at 2 or 1 or 0, but if you pick 2 and its expectations are drifting down, you're losing credibility. So there's a lot of things that happened in the 2010s. We were at 0 lower bound. The economy was recovering from the financial crisis. Massive amounts of regulation went in after the financial, particularly in the financial sector. And all these things do nothing but slow down growth and put downward pressure on demand and prices. So we took the 2020 approach, was like, we got to get inflation to get closer to 2, so the expectations come back up, our policies are more credible. And so one thing that people thought was, when you say 2%, is it a ceiling where you're happy if it's 2 or less? Or do you really mean it's 2, so that if it's been low, you let it run above? So on average, you get to 2. And that's what John was saying. That was called flexible average inflation targeting, meaning if we had been running below target for a while, we were willing to let it run above target to get it back to 2. That's as simple as I can explain it. The problem is, as soon as we adopted this policy of saying we're going to let inflation run above target, guess what happened? It went all above target, all by itself. We didn't have to do anything. So the whole framework kind of got blown out of the water right away. And so, given that we've been above our inflation target for about 5 years now, it's like, why are we saying we'll let it run above target? Because it's been running low. It's not been running low. So we had to step back and say, look, that framework was too tied to the 2010s. It was, in my view, I'm speaking for myself, it was too backward looking. It was too specific. It was too cute in a way of how we were going to manage things, too discretionary, too much fine tuning. And I think we've realized, look, we want to go back, talk about our strategy, but do it in a more robust, less detailed, less complicated way in terms of how we're going to approach things. And that's, in the end, that's kind of what the new framework does. It kind of goes back to where we were roughly in 2012. And we're trying to make sure that whatever happens going forward, this is a robust framework.
Yeah, I think that sort of reflects, I think, a broad kind of consensus amongst economists that flexible average inflation targeting was maybe a bit of a misadventure. I want to talk more about the balance sheet for a second. So think quantitative easing, quantitative tightening. This is the Federal Reserve going out buying, say, long-term treasuries and mortgage bonds and so forth, that they started doing largely after the global financial crisis in 2008. The Fed balance sheet's now at about $6.7 trillion. It was at $9 trillion in 2022. How does the balance sheet factor into your thinking? And is a big balance sheet something that you think we're going to have maybe forever? Do you think we could ever get back to reserve neutrality? And where do you think the balance sheet's going in the future?
Yeah, so I just gave a speech on the balance sheet about 6 weeks ago, trying to explain what our balance sheet is, what are our structure of it. How should we structure a balance sheet? And I made the joke that most people would rather go to the dentist and talk about the Fed's balance sheet. I see people starting to walk out already. So they're But the punchline is we have three major, I'll do this all in like a ChatGPT version of the speech. We have three major liabilities on our balance sheet. We have currency, which is about 2.3 trillion. The Treasury's checking account is on our balance sheet. We're the bank for the U.S. Treasury. Normally it's about $800 billion. So you're up to about 3.1 trillion. And then we have a policy that we want to make sure banks have enough liquidity and reserves that we never have a panic where everybody's chasing, looking for loose coins in the cushions. The banks always have the liquidity that they need. What the right amount of liquidity that the banks need is an open question. And right now we're kind of staring at this, and let's say it's somewhere between 2.7 and $3 trillion to make sure the entire banking system has the liquidity that they need so we never have to worry about running around chasing currency. That means your balance sheet's close to, it's close to about 6.2 trillion, 6.0, anywhere from like 5 whatever to of that. That's a large number. It just sounds like a big balance sheet. And it's certainly bigger than what we ever had pre-global financial crisis. But the point is, even if we got rid of all the reserves, we went back to a scarce reserve, what we call the scarce reserve system, where you had maybe only $25 billion instead of $3 trillion of reserves, our balance sheet would still be well over $3 trillion, just from currency and the Treasury's checking account. So about half of our balance sheet side is out of our control, really. Currency, we print on demand, and there's a good reason for that. We never want anybody to doubt when they go to their bank and they want to say, I want a dollar bill, that the bank says, I don't know if I can give it to you because I don't know if the Fed will give it to me. The answer is we will always give you that dollar bill. Don't worry about it. Make sure your customers know they will never have a problem getting currency if they want it. So there's a good reason we supply it on demand. And the Treasury's checking account, that's got to talk to Scott Bessent. That's his decision of how big they want to carry a balance. And just over time, that thing has gone from maybe 25 billion 20 years ago up to like 800. Part of it is just the fact that we have much bigger government spending and bills have to be paid in a larger amount. And that requires, in general, you have a bigger balance in your checking account. So in a nutshell, there you go. That's the balance sheet. Enjoy. I hope you sleep well, Tom.
All right, very good. Sure, many will be sleeping safely at home, knowing that we'll have a big balance sheet for quite some time at least. So debt and deficits. I want to talk a little bit about this because it's something that gets talked about a lot. So one, I think the debt to GDP ratio in the U.S. is now past 100%. There's often criticism of continued deficits is more of a fiscal policy question than a monetary policy one. But in my mind, despite all the haranguing about debt and deficits, the 10-year yields, maybe 4.2%, the 30-year yields, about 4.9%. They've been much higher in decades past. Do you think the federal debt is something that the American people should be concerned about? What do you think about?
Yeah, so typically the thing is with deficits, we're running about, in the last few years, and it looks like this year as well, we're going to be running deficits of about 6 to 7% of GDP. Typically, that number should be closer to 3 to be what we would say as economists, what would be sustainable going forward. So if you're running 6% deficits as part of your total national income, when I say GDP, it's our national income as a group, you're incurring a lot of debt given what your income is. That's what the debt to GDP ratio means. Now, the thing with the debt is it's going to be potentially paid off hundreds of years into the future. We can pay it off as a country. There's no end of the life of the country in some sense. So you can spread out the repayment of that debt over decades. It doesn't have to be all at once. But you can't just continue to run these kind of deficits for 100 years, 200 years. It just doesn't quite work out. So while it's not a problem per se today, it's not on a sustainable path. And at some point, it'll have to be reined in. I don't tell Congress how to either rein it in by cutting spending or raising tax. That's not my job, and I leave them to do that so they don't bother me on interest rates. But I mean, this is just kind of arithmetic. If you don't get the spending deficit down, your debt's going to grow as part of your income. And at some point, markets are going to stare at it and say, look, I'm not financing that anymore. Or I'll finance it, but at a very high interest rate. And that's what we've seen around the world when some countries get to very high debt limits. The exception always being Japan. Japan has a 250% debt to GDP ratio, and they have interest rates close to zero. So obviously something, either people believe Japan will pay this off over 1,000 years. They've been around for a couple thousand years. Maybe that's it. Long civilizations are more tolerant of what they're willing to incur. So that's just been a position I've taken. We're not on a sustainable path. It doesn't mean we're in any kind of trouble now, but at some point, we're going to have to get some sort of fiscal discipline. And I'll let Congress figure out how to do that.
One question, also sort of non-monetary policy related question, really just on payments and I guess Finnish regulation. So for those that aren't aware, on top of sort of managing monetary policy, the Federal Reserve also focuses on regulating banks, also managing the payment system. Chris spends a lot of time in his own capacity managing sort of the payments part of the portfolio. I'm curious, can you tell us what's sort of been going on in the payment space and during your tenure and how things have been changing? The Genius Act was just passed that changed a lot for stable coins and that space, but there's a lot going on in this space. Could you explain to the layman here what's going on behind the scenes and what you've been working on at the Fed?
Yeah, if you thought the balance sheet was boring, wait till you start talking about payments. So I'm the payments oversight governor. I oversee the U.S. payment system. And 25 years ago, if you'd said payments and who's doing payments, you'd think of some guy in a green visor and a pad and a pencil. But it's actually become one of the hottest tech jobs in the world because all of this stuff is moving into more technology and it's being handled by non-banks, fintechs, everything. Stablecoins is a new form of a payment instrument that's come about from the crypto world. Just because I said crypto, don't get scared. It's just a stable coin, which is a promise. You give me $1, I'll give you this digital dollar, and if you bring it back, I'll give you your dollar back. It's really no different than a bank account at that point. I give a bank $1, I come back and ask for my dollar, they give me the dollar back. But what it does is it opens up a new set of payment rails in the U.S. through the crypto world. They don't run on Visa, MasterCard, they don't run on the bank rails, they don't run on the Fed rails. And that just, for me, that just introduces competition to the payments world. And what that means is this should drive down payment costs for all of us so that we can make payments across each other, cross borders, cross everything at a much lower cost. And my view is let everybody that wants to get in this business do it as long as they follow whatever regulatory structure we put in the Genius Act. Banks should be allowed, non-banks should be allowed, but it all has to fit within the clear regime that we set up. The Genius Act is a great start, but it's never going to be perfect right out of the gate. We're going to learn there's going to be some issues, some problems, but we'll fix them as we go. And that's the critical thing. We're not going to just shut everything down because we're afraid somebody might lose $1 or somebody might get scammed. Somebody might lose money in their assets. You just have to take risk. And that's what we're going to do. That's how the economy grows and gets better, is you take risk. If you don't want to take risk, you can become Europe. So, sorry to my European friends.
Well, I know Miami, I think in many respects, thinks of itself as the capital of crypto. So I'm sure there's many in the crypto world who are very thrilled that you're here and talking about payments and stablecoin issues. My last question for you is related to college football. This week, college football.
Oh man, I'm getting still thrown up.
Is starting again this week, and it just so happens to be the case that Notre Dame is playing Miami, University of Miami Hurricanes this week, actually here in Miami this weekend. And I know, Chris, I know you're a big Notre Dame fan, as am I actually. Any thoughts on this weekend's game? I mean, how many points do you think Notre Dame's going to by? And keep in mind here, you've got many Miami Hurricane fans probably in the crowd here, but any thoughts here?
All I ever say when I'm in enemy territory, I just hope for a good game.
Very good, very good. Well, Chris, I want to thank you for coming to the Economic Club Miami and for appearing in the special live taping of the Capitalism and Freedom of the 21st Century podcast. I hope that I hope that Notre Dame does better than they did in the finals last year and in 2012 when they played Alabama actually here for the championship then as well, which I think you were actually at.
I was at.
It's painful memories, but hopefully this weekend it'll be a good game. But Chris, thank you so much for coming. This has been an amazing conversation. Thank you everyone for coming.
Hey, so thank you all.